Okay, we're live. Echo. How do I stop this? Oh yeah. Skip forward about 2 minutes because I am a boomer and I need to send this out the old-fashioned way. So we get some homies in the chat. Okay, I'm doing this faster at least. What's my quant thinking? My quant thinking is buy the dip, buy the dip, buy the dip. That's what my quant says. Yeah, so this number one, let's talk about AI real quick. What we have is basically the market realizing, or what's going to happen is the market's going to realize this is more about like the railroads than it is, for the interim. I don't know about the end state. You can't do inference in China. They don't have the compute. It's too far away. Latency is too high. If you use Kimi, it's actually quite slow. It's good. It's quite slow though. It's cheap. This all is more utility. The utility functions not change when you're doing data center spend, when you're investing in OpenAI and Anthropic. Sure, the numbers change. Gavin Baker talked about it. I was saying that before he came out with his tweet. There's not much to add there. On Groupon, you know, of course, this morning, yesterday, I'm talking about the changes and fundamentally on this app, it is not a question of, um, Airbnb doing a little bit better and, you know, their app is a minor improvement. This is a massive improvement. You're going from 2006 to 2026. And, I can't emphasize this enough. The UGC content, I should pull up my model too. I'm going to show you what my models uh, says. It has no real inflection in user growth. UGC could absolutely be that inflection. Like it's, you know, if user growth is growing the same time at retention, and if you aren't uh, sort of e-commerce platform based, you may in fact not know what retention is. It's basically the amount of times that one user comes back and purchases something on the platform. Having a better app, people want to be on more. Beautiful, right? That's beautiful as far as retention goes. However, um, if you're also growing user growth, like this could be, a hyper growth few years on that. So here's my model. This is yesterday's prices. The market cap just over a billion. 12-month price target 63. 24-month price target is 90 and 160. 30 on full potential of the retention unlock, just going to peers. If it's better than peers, again, not this is a price target with a lot of upside. I don't need to, be delusional and be like, what if everything goes right? I mean, that could happen. That's not something that you underwrite. The drivers of this model. and this business in general. SG&A cost cuts going down. Um, Frequency is the biggest one. This is what peers are at. This is what they're at right now. I think it's going to go to at least 3.5, halfway to peers. Incremental flow through, you know, when someone stays on the app and they purchase more, I think this is probably conservative. It just means that, you know, it's basically pure profit. This is ultimately a platform. It costs to run the platform, you know, it costs to get people onto the platform. Once they're making purchases on the platform, there's not much. There's not much. This is going to take a moderate amount of tech growth, but certainly some tech growth. They should be investing. A company like Groupon, and especially if there's Kimi, and Kimi can cut costs on the token spend, but there's going to be a high ROI on that. It's it would have taken them in the past to do what they've done so far and are going to do, 25+ million dollars. Last year in August or so, they were knocked offline on their re-platform. And what that led to was, they hired a bunch of consultants in India to like get us back up, get us back going. With AI, the total spends there are like way, 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 way lower. SBC is declining. That just kind of tends to happen when you cut headcount. So, especially as the stock's going up, you can incentivize workers for less, but you're cutting headcount right there. And then the executive SBC, they've got their SKUs. What's best for the business? They're well aligned. If you're Dushan, are you going to take a big SBC stock-based comp if it's going to hurt the vast majority of your shares and Pale Fire shares? No. So I see that going down. That's been something there, and some other drivers. Again, frequency, every single, if you go from 2.3 to 3.3, 2.4 to 3.4, that's $100 million of EBITDA. Like it's pretty insane what that does. It could be even higher if the flow through is higher. Um, this is what I want to highlight, right? Right now, coming into the year 16.2, call it 16.5, end of the year, we're going up like barely, right? Like less than 200,000. So if you get UGC gets 2 million Gen Z users on there, that would be pretty crazy. Another thing that's not built into the model, but I suggested to them, and on the call they were open to it, and it's not like it was exciting, is what if you gave, for $5 per month, a Groupon Pro or a Groupon Plus? That would be stable revenue. It would make people come back more, and you can give them like a 10% discount on all Groupon deals that are already discounted. I think that would be a really interesting ad. One thing on the working capital, this is a negative working capital model. So they get the money in the door before they pay it out, which, on a present value basis is nice. As long as this business is growing, that means that free cash flow should be higher than EBITDA. And that's the cash flow. This is the buyback math. I studied up a little bit on how to model this out, and there's a few academic papers that led me to this. The shares retired in 2026. This is based off of SumUp being monetized, and then they've already retired about 2 million shares. In my view, since the last report, they probably retired 1 million more, so we're at 3. If you want to push this, the 6 remaining, whatever adjustments you want, the SumUp stake isn't sold early fine, push it back into the 2027. But ultimately, they have excess cash, and management has said that they only need to operate with $100 million of cash. As of the last quarter, that was $225 million. Could they buy back the converts? Yes. That would be another way to make sure that the share count stays lower, as I have this on a fully diluted basis for when my price targets are above the strike price of $54. Now, this $54, it has to trade above 70 for a certain amount of time for it to exercise. And then it automatically exercises, I believe. I believe that you're going to be looking at, over the coming years, 21 million outstanding shares versus 38 that we saw most recently. So you can use that to apply to your, you could use that to apply, to where you think the market cap is going. There's going to be less shares outstanding. I'll tell you that. So some up stake, some people, want to say it's worth 8 billion. I think it's worth more. I think it's honestly worth, probably about 12. If it went IPO'd today, I think it could IPO at 12. I know that there's been negative news out on it. I don't care. The UK has no growth companies. It's going to trade well. Okay. It's going to trade well. If they're trying to miss the window where everyone's excited about SpaceX, Anthropic, OpenAI, sure, whatever. I could see it going public at 15 billion. My assumption is just 200 million. You could do 180. It doesn't change it that much. One thing that I think is key is subtract it from the enterprise value. That's non-core, whatever you want to assign to it. That's what you're buying, because if you just do a Google search on enterprise value, you'll get 200 million higher than this. The stake in SumUp is not part of this enterprise. So I did the operating EV. On the DCF, what did I stay with on WAC? Well, if it's 12, 14, whatever you want, I applied a high weighted average cost of capital. It may be lower. And as you know, if you've done a DCF, you change the discount rate. It's a lot of torque to it. But based on my assumptions, it's spitted out a $66. And, key thing is, if there's a 12% whack, if you just hold this and the numbers stay true, if this was a perfect world, because the cost of capital is 12%, every single year, it should be beating the market. That's just what it means. So we have options expiry today. That means that there's, some premium kill, as will happen. And after this, I expect it to be like, kind of like July, right? You noticed how the July expiries happened. A lot of calls were zeroed, and then it just started ripping right afterwards. So I think, the time for exposure was yesterday, was the day before, but it's not a bad day to buy, because on Monday you got some, healthy, it's going to be healthier from the market maker's perspective. The majority of this volume, like you see 2 million shares yesterday, it's market makers. There was 18,000, there was $1.8 million of notional value on the options that were bought yesterday. 1.8 million shares. Okay, so that's $45 million. Over that, $50 million. Now, on a delta basis, maybe that was, I don't know, $25 million. That drove most of the volume, right? That doesn't mean that there's shares necessarily, out there. I think the liquidity is much lower than the volume profile. Volume has gone up, and now it says 6 days to cover. I think that's entirely deceptive. How do I think earnings going? I'm going to go through the comments now. Well, you want to see what the the market or the three analysts. Like I don't even know if people actually listen to these analysts because they don't know much. Well, let's just say Goldman Sachs doesn't know much. They do not give a shit about being accurate on this company. Um, 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 annuals, quarterly, launch and oh, I probably have it under here, huh? Yeah, group. Okay, Q2 estimate on EBITDA 14.6 million. I should have mentioned this in my Substack. Where did I put it? Um, 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 um. Did I not put this in there? Did I edit this out? Yeah, so 17, 18 million dollars of EBITDA. That's what I have. If it hits that number, it's going up like a lot. You know, that's just what I think it is. If you look at the real time data, the search history going back to June, it all looks good. It all looks good. So, if it's 20, we're going to rip faces off. Billings probably 385 is good. Margins matter when you get there. There's going to be some severance in the EBITDA, so you have to add that back. Um, so if it's 18 plus $2 million severance again, like that's really quite positive as well. Um, 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 why don't I show off a little bit? So this is the mispriced assets portfolio. It is a mock dashboard. It's not my PA because I think this is better signal, quite frankly. Unlevered, long only, and up for the year. It's 38.6%. Started with 10 million. 1.91 sharp for long only is crazy. If you took that over the Warren Buffett was zero point 0.6, like I'd be the greatest of all time if I was long only 1.9 sharp ratio. Um, I do have beta. It's hard to buy stocks with no beta. But having said that, I think beta is kind of bullshit. I really do. I think it's bullshit. Groupon technically has an over one beta. It's up yesterday. The market's down. Does a 2 year beta. I just got to do it. I kind of don't like it. I capture more of the upside, less of the downside. Um, Calmar ratio is good. This CAGR's insane so far. I mean, there's enough sample size here on the stock picking um, that I can feel good about it. So just wanted to show off a little bit there, and then yeah, let me just go through the comments. Thank you, thank you. What's up, Substack squad? I'm gonna exercise like another 1,500 shares. I think. I get some 21s, 22s. I think maybe, yeah, something like that. Something like that. And then I got some calls in August, and um, pretty much every expiry do I have some calls. The share position is going to stay pretty pat, and then really what's going to change is um, the if I do trading, it's likely going to be about around the calls. Um, so yeah, down 1.5%. This is like DeepSeek 2.0. Probably means a little bit. Uh, the DeepSeek thing was more dumb than holy shit, we're investing and there's huge valuations and what are the economics. Like I think that really changes than like, oh, Nvidia is going to sell less chips. Like that was like extremely dumb. But I think it's going to end up being a little bit more like that. Listen to Gavin Baker is what I would say there. It doesn't feel right. This is where I've been de-risked from AI. I thought it was like stupid. I've built a lead on the year. I'm fine taking these, quality high beta stocks like Coherent and otherwise. Back into Coherent and pretty decent size, as well as select others that I'll be writing about on Substack this weekend. But yeah, the Fermi update. I haven't added to it. Look at the like. What do we want to look at here? People's fate. We could look at Applied Digital. Look at that. So just compare it to the competition. I was a little bit too early on that. We'll see. It either works in a month or I'm out. Look at people's favorite is Nebius. These guys are all kind of like shitting the bed a little bit. That's tough. 300 to 170. That's down 40+%. That's really tough. Especially if that's your biggest position, as some people are. But yeah, I mean, when you have amazing power assets, you just need to not fuck it up. And there's hair on it. Um, well, yeah, yeah, but that's 2028, and it still has that price target, right? And you could get to $90 next year, based on user growth. But right now, I have a $90 price target for in my base case, for 2028 on 2028 numbers. I think Groupon with the growth that I'm projecting them to have deserves at least a 13 and a half multiple on EBITDA. So bookings at about that. Bookings at like 14. You want to look at booking? Let's look at booking. Blah, 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 blah. I'm kind of negative on booking. Like everyone's loved it. It's been like a really, favored stock for a while. I guess I should make this smaller. Okay. Right now, 140, 11. So it's like 13 times EBITDA. It's like 14 times EBITDA. 13.5 or whatever. EV to EBITDA. 14.7. Okay. Look at what it's growing. I guess that doesn't have the growth rate on it. What are we doing? Company model. No. Damn, I'm rusty ooh, I'm rusty. I'm rusty. Where's the growth rate? Where's the growth rate? I'm doing a lot of credit work too. I'm like, ooh, this is cool. When you pay for Bloomberg yourself, I'll tell you what, you get um, more excited on. There we go. You use it way more. So Groupon's growing, 13%, 10, 11 to 13%. I think Groupon's gonna be growing 20. I think it's gonna be growing 20. So you apply a little discount to it, you can still give it a 13.5 if bookings at 14. So anyway, I'm on the West Coast. It's 8:41. I haven't eaten yet. It is time for me to eat. So let me just go through the last questions if you guys want to pop them there. Yeah, I was working on the model. I'm sure things changed. I moved some up, down. I might have pushed out the buyback. Models are fluid, but the fundamental assumptions are basically there. Um, if you're talking about the TikTok one, yeah, definitely. Like I made that model. That was the first day of making the model. I've been playing with it and working with it and trying to get more accurate. It's still it's like how much I criticize private equity for their models. Don't hold it as a guide point. The reason why I think it's extremely useful is because uh, when you start playing around with it, you realize like what drives the company, right? So anyway, maybe I'll be on live later. Maybe I'll be on TikTok. Make sure to turn your notifications on YouTube. It's nice to start out with people immediately coming on. I like the September expiry, the October expiry for Groupon. I think it's going to be a beat, and then giving yourself 30 or 60 days trading under that. Premiums are expensive. Just, be careful, be rational. Selling puts, like, you're collecting that premium. What do you think the real downside is into this inflection? Whatever your answer is, wherever you'd want to own shares, be smart. But you can use that information to take advantage of the options chain at time. I mean, if we're looking at puts on August, sell a 25 put for $2. If it misses, you own Groupon at 22, 23. If you're not just going to be in it for a quarter, like, okay, like, well, it misses, but in the next quarter you have all of the numbers inside the rebrand and it's a super low uh, comps on the business. Like, we should look at this. Q3 2025 revenue went down. Q4 went back up. Q4 seasonally strong, but you're going over, and but there's a lot of like winter issues, and there's they shut down the Italian business. There's a lot of hiccups that happened in the second half of last year, and now we're going into the second half of this year, uh, where the comps are like pretty low and the estimates are pretty low. You know what I'm saying? Q2 beat Q2 on billings. Q or no no no. Q2 is expected to beat Q2, but if this is more like 130, that's gonna really it goes straight to the bottom line. You know, really what I'm looking for is EBITDA. We'll see billings on this. It would be good to see it go up, but you're looking forward to Q3 that has the rebrand. It has the redesign, and that should drive a tremendous amount of performance and an excitement about the performance. So I like the October, strike. I like the January strikes. I like the January 2028 strikes. Yesterday, the Januaries got absolutely blasted. Um, the January calls got absolutely blasted yesterday. So someone sees what I see. Do you see what I see? Way up in the sky, little lamb. Yeah. So the Bloomberg salesman, Michael Bloomberg. Whoa, whoa, man. Whoa, man. Might have a coffee date set up. All right. Yeah. Signing off. I'm just too hungry. Maybe I'll be on later. Peace.